online.
Good afternoon, everybody. Welcome back to the Opportunistic Trader. It is 2 o'clock on December 6th, and we have some options talk going on. We're going to have Vince Lanci and Tom McEntee talking options as they have, going over a lot of different strategies, ideas. Um, right now, Tom's running a few minutes late, so we just have Vince. And Vince, I actually need to hand it off to you. I'll let you take it from here.
Thank you. Thank you. Good afternoon, everyone. We are going to basically do this free form until we get Tom here. There's a couple things we could talk about. We could talk about while the stock market is down, you're long a put that's in the money. We could talk about volatility, but I'm going to throw it to the floor. If there's a question out there on anything options related, I'd be able to do my best to answer it. If there is no question to start with, we're going to start by looking at a chart that I threw up there about the stock market. So I'll give you a second. Any questions would be in news Q&A. All right. Okay, so why don't we start with this? There's a chart. I'm going to make this about options because it is about options directly. All right. There's a chart that I put in there in news Q&A a little while ago. Today, you could see that the VIX made a new high. Now, this is directly relevant to things that Larry talks about, and this is also about options. We'll make this about options because everything is options. If life is options. The VIX made a new high today. Okay, but the RSI, and there's other things there, but I want to focus on the RSI because I understand that the best. The VIX makes a new high, but the RSI doesn't. So that's what's called in the markets a negative divergence. So the market makes a new high, but the indicator called the relative strength indicator does not make a new high. So the relative strength is fading. You could say another way to look at it would be possibly it made new highs, but on lighter volume. There's less people trading it. Perhaps it's running out of gas. Now, when you see something like that, that in and of itself is bearish for the VIX or bullish for stocks. Now, if I were trading this intraday, instead of this being a daily chart, it would be a 15-minute chart. Someone like Larry might look at this and say, oh, look, the VIX is making new highs, but it's lightly traded. I would look at an RSI and say the RSI is not making new highs, and I would cover shorts in my stock. And I would expect the stock market. This happened very recently. I would expect the stock market to rally from here. I also think there are stops above 26.69. Now, how is this option related? It's option related because frequently you'll see a market like I don't think this happened in natural gas, but I'm gonna pretend it did because it has happened in the past. Natural gas makes new highs, volatility pops. So in the instance we have here, I'm using RSI as the negative divergence, or as the thing that tells me that the VIX is not going to keep going up short term. Conversely, stocks should rally if the VIX comes off. But to make it simpler, this happened to me many times. But natural gas will make a high, and volatility will be at 40%, let's say. And we're in a call skew environment, and that means in a rallying market, volatility will pop. Wintertime, we'll call it. So the stock market, natural gas makes a new high, and vol pops, and calls are bid for, and then the next day it makes another new high, but calls are offered. In fact, the call offers stay there even as the market continues to rally. Volatility actually comes in the rally, and I used to use this as a negative divergence. If there are options being sold and the market is still rallying, then to me, that says either they're a buy and they're undervalued and I should buy them, or we're close to the top of a move because people are starting to liquidate. Now, not everyone's starting to liquidate. You could be wrong, but the fact of the matter is, as an options trader, if I was long options, I was long Gama. So if natural gas makes new highs, but volatility doesn't make new highs, I would sell my futures out more aggressively. We're also privy to Mike's personal life there. Anyway, talking about options, if anyone would like to hear something about, say, actually what happened in the S&P the other day, uh, it's my understanding when the S&P rallied and then closed, people got exercised or people automatically got assigned longs and they sold. If you look into it, you'll find out that a large fund sold lots of deltas and notional. And when you hear the word notional, you think, futures or underlying. But when you hear them talk about deltas, they're talking about options. I think someone got stuck long from options and hit the market really hard. But onto options themselves. You can trade interest rates using options as well. Is anybody interested in that, or are they more interested in speaking about directional plays or volatility smiles? If there's anybody tuning in today, if not, okay. So let's talk about how long-term capital blew out, which was options based. Long-term capital was comprised of two gentlemen that were giving them their options, Myron Scholes and Fisher Black. Hey, Gabe. Gabe, what would you want to talk about? Anything. I'm all yours until Tom gets here. Then I'm his. Long-term capital? Okay. All right. Here's how it goes. Long-term capital was doing a trade, and they were basically betting on convergences. So it's kind of like red dollars and blue dollars will converge with green dollars. And they were short the red dollars and long the blue dollars. And they had this thing on, and it was a good trade, and it would converge, but they were running out of money. And so they were doing things to raise capital. One of the things that they did was they actually sold gold and used that money to finance it. But they blew out directly because they called their banks up and said, "Hey, this is a great trade. We just need more money. Can you help us out?" And of course, the banks ran them in. But the optionality that's involved goes like this: the long-term capital guys that were the brains behind it were the people that invented the Black-Scholes model. Now, the Black-Scholes model is the first model that caught on in trading options. The thing about the Black-Scholes model is it assumes a normal distribution. Mike, can you mute yourself? All right, Gabe, wait a second. Let me text Mike. Stay with me. Oh, you don't? Okay, Mike. Okay, good. All right. So anyway, Gabe, that's just on my end. So it goes like this. They were using a model that was based on regression to the mean, which was basically a Black-Scholes model. It assumed flat tails, or technically called platykurtosis. It was a normal distribution, a bell curve. And basically what they were saying is when something gets to be at the extension or the extreme of the bell curve, two standard deviations out, we'll sell it on one side and buy it on the other. And that's what they kept doing. What they weren't counting on is Murphy's Law, fat tails, uh, 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 models that model these things differently now. I mean, it's actually a boring version of it. I could be much more fun about it, but it won't be options oriented. What ended up happening was uh, uh, the market gets beyond where you're averaging hedges. So for example, an asset trades between 1 and 5, and when it gets above 5, you sell it, and when it gets below 1, you buy. My asset, I mean two assets and the relationship. They have a correlation between 1 and 5 in differential. So it's usually trades from 1 over to 5 over. We'll say one asset A trades 1 over to 5 over asset B. So when it trades less than 1 over, you buy it. When it trades more than 5 over, you sell it. And that ratio could be that number could be generated by an options model. And an options model that's Black-Scholes would give you 1 and 5, and that would give you 2 standard deviations. And 2 standard deviations is what volatility is. Volatility is a standard deviation. It's basic statistics. So what ends up happening is gets above 5 standard deviations, and long-term capital, above 5 points, which is 2 standard deviations, the long-term capital sells. And then it gets to 6 and long-term capital sells again. And then it gets to 7 and it's outside the norms. It's a black swan for them. And they don't understand. So they keep selling, and now they have no money to sell anymore. So what ends up happening is the market blows through their levels because they have to cover. This is not one of my more exciting stories, but the point of it is, hold on. Can you still hear me, Gabe? Okay, so if you're trading something, okay, good. If you're trading something and you're relying on a model and you're swearing by a model, as most options people do, you're going to get burnt. I think the expression is an options model should be used as a candle in the darkness as opposed to a flashlight that gives you the answer key. So what we're looking at is uh, when you have a situation, and I'll give you a direct situation in options that happened to the first firm I worked at, where you get outside your normal parameters and you say what's going on. So here's the situation. Now, I'm not going to define it too much for you. I don't want to overcomplicate it right now, but there is a structure in options called a box. And a box is made up of 4 options. And the box, when you trade a box, it's an interest rate thing, but that's not the point. The point of a box is it can only be worth as much as the difference between the strikes. So if we're looking at the S&P, let's say we're looking at the 2,000, 3,000 box. We're not going to get into what the options are involved in it, but the 2,000, 3,000 box cannot be worth more than 1,000 ever, period. It always trades at a discount, and it's based on interest rates. It can't trade above 3,000. It's impossible. Okay, so of course you know where this is going. So the firm that I worked at was called Cooper Neff, and in Philadelphia, there was a box trading on a stock, and it was we'll call it a 2,000, 3,000 box, right? It was an individual stock, and that stock traded at a price under 1,000. Now, if that stock was trading, if that box traded at, forgetting about where the stock was trading, doesn't matter where the stock's trading, but if the box is trading under 1,000, the discount it trades under 1,000. Let's say it's trading 995. That $5 discount is a reflection of interest rates or the cost of money. So it's a purely an interest rate thing. That's nothing to do with direction of the market, and it's the way people borrow and lend money. So a box that trades at 1,000 is trading at 0% interest. Let's put it that way. So if you can sell someone a box at its maximum value of 1,000, you're borrowing money from that person at 0%. Are you with me so far? Are you with me so far on the box explanation? Okay, you don't have to understand what a box means. I just want you to understand this. If a box is worth 1,000 and you can sell a box at 1,000 to someone, you are borrowing money from them. Let's not get into why or how, but this is about understanding options risk. Uh, if you can sell a box to someone at 1,000, this is a story about understanding probabilities. you are borrowing from them at 0%. So it's kind of like when interest rates are trading 9 or 10%. So a box is just an options bond. It's a bond created using options. So this company that would compete with the company I worked at Cooper Neff. The company that competed with them was CRT. Now, boxes usually trade at a discount to their complete value, so they could be at the most worth 1,000. Whatever the discount is to 1,000, that's a reflection of interest rates. So we're not going to get into that. But whatever interest rate, whatever the bond yield is trading at, that affects the price of the box. So someone comes in and interest rates are at 9%, and they start buying this box. And boxes are not something you normally trade. I mean, who even knows what they are? So they start buying this box, and they start buying this box, and they're driving it up. Basically, they're lending you money. If you do this trade, they're lending you money at 8% when yields are 9%, 7%, 6%. And before you know it, the box is trading at intrinsic value, which is 1,000. So at 1,000, or the maximum value of the box, which is an options-based bond, okay, you are borrowing money from the person who's buying the box from you at 0% interest. How much money would you borrow with 0% interest? Well, the answer is all of it, as much as you could. Maybe not in France or in Europe with rates the way they are now. But when rates were 9%, if you could borrow money at 0%, you would do it all day. You would mortgage the family, you'd sell the house, you put a second mortgage on the children, and you'd borrow it at 0%. Then the box trades over 1,000. So if you're willing to mortgage the family to borrow at 0%, what are you willing to spend? What are you willing to mortgage to borrow money at a positive yield? It turns out that the interest rate on the box was accurate. There was a point where whoever was buying this box was lending money to the market at a yield that was negative. So if the company I worked for sold the box at 1,001, they were borrowing money and being paid interest. And this is the situation where you have to let the options uh, uh, theory go out the window, because you're thinking, I'm borrowing money at a positive number. What is wrong here? What do I not understand? And what ended up happening was, and this is what happened in long-term capital management, they didn't allow for they didn't know what they didn't know. What ended up happening was, and this is where I'll probably lose you. Uh, the box is a reflection of a call spread and a put spread combined. Turns out, and we can talk about it some other time at an advanced class, this was a two-tiered takeover. So the company that was trading at, let's say, $2,000 was going to be taken over in a two-tiered fashion. So 80% of their stock will be taken over at $3,000, and 20% of their stock would be allowed to float at $1,000, which simultaneously made the box worth, $2,000, which we're not going to get into. But anyway, my company covered it. But since then, and this is the punchline. The punchline is we were mandated to run them over whenever we could in New York, and part of that would be standing in the ring. And there it was CRT, and they were a better run company. We had better traders, but they were better at centralizing risk and running it better that way. So we would do things to confuse them by giving orders to brokers. Anyway, this is an anticlimactic ending, but the point I'm trying to make about the options risk here is that when you think you know everything you can statistically about options, and even directionally, there are things about the market that are bigger than it. Does that make sense? Let's talk about the S&P. You have the S&P on your screen right now. I want to talk about, let's trade options on it. Let's play a little game here. All right. The S&P on the screen is trading, on your screen is trading 2662. Yeah, I definitely would love to do that, and I think we'll do that in another class, XDM, because I don't have I don't have my screen available to do that. I'm a whiteboard type of person, but yeah, 10% really would be the amount of discount, the opportunity cost of the money. I would love to do that, but I think Tom's going to come on and we'll end up talking about something else. But I will cover that. Let's talk about yeah, I know you get it. I know you get it, XDM. But I'd be happy to go through that at a more in depth level some other time. But for right now, let's pretend, right, Gabe. Gabe, the stock market is trading. The S&P is trading 2662 right now. I think you see that price, right? Let's pretend that you bought a put at XDM and Gabe. You both bought puts at 2700. You bought the 2700 put that is now in the money by 38 handles or $38, as people say now. You have choices as to how to take those profits off the table. You can either A, take those profits off the table and walk away, B, lock in some of those profits and then play with some of the other profits, or C, put on an entirely different bet that adds risk and adds reward. Gabe, you're long the 2700 put that's now in the handle, now in the money, 40 handles basically. All right. Do you want to take profits or do you want to let it run? XDM, you too, obviously. If I don't get, all right, tell you what, okay, fine, good. All right, so your first choice is taking profits. In fact, why don't I just go through all the scenarios? That's a good point, Gabe. All right, so in the first scenario is you sell the put. So whatever you bought the put for, you subtract it from the amount of profits, and there you have it, you sell the put. The second scenario is you still think the market is going lower, but you want to make sure you've locked in some profits. Now, there are complex and more complex ways to do that. One thing is we're trading at 27.57 now. You sell the 26.57. You sell the 26.50 put, and now you're long the 2700 put and short the 26.50 put. And I don't have the prices in front of me, but you've probably been paid a credit to do that. And if the market sits here or goes lower, you will make the maximum amount you can make between those strikes. The maximum amount between 2700 and 2650 being 50 handles. So what you've done now, as you said, I'm still bearish, but I want to at least stop my. It's like kind of using a stop. I'm going to at least lock in some profits by doing a put spread. Volatility is higher, and that's one way to do it. Second way to do it is, and this is a person who trades or swing trades, you'd say, I'm still bearish overall, but I think we're going to bounce before we go back down. And you don't want to trade options when you start trading swing trading because the options are created for swing traders. And swing traders are people who I'm bearish, but they buy and then they sell. They sell. They do contrary trades within their macro point of view primarily. So let's say you want to take profits on the table, off the table, but you are still bearish. Instead of selling that put, which basically locks you into a position, you could buy some ES. You can buy some futures. And what that does is, let's say the delta of the 2700 put at this point is, say, 65. And let's say you bought 100 of them. You can buy 65 ES and be flat deltas and have no exposure to the market in either direction. But if the market goes higher, you can sell 65 back out. If the market goes lower, you have another 35 you can buy. So that would be called converting. That would be basically converting your put into a straddle. So you make money both ways, but you still have a lot of premium on the table. A third scenario that involves taking profits but having risk would be selling. And this is actually fun to do once you know what you're doing here. If you say I'm bearish, but I don't think we're going much lower, you could sell 2 of the 2650 puts. So now you're long one 2700 put and you're short 2 2650 puts. Now that is in and of itself what's called a back spread, and you would lose twice as much money below 2650 on the two that you're short than you would make in the one put that you're long the 2700. So the person who sells the two options, what they're doing is they're saying, I'm really not that bearish quickly, I'm bearish slowly. The most common thing people do that think like this is they say, oh, look at that. I bought a 2700 put for $1. It's now worth $30. I can sell the 2650 put 2 times and I'll lose money. And this is the fact, I'll lose money below 2600. So I'll buy the 2600 put to stop myself out. And then what they do is they create a butterfly, 2700 put that you're long, short 22650 puts. I know some of this is over your head, but we're going to, or I'm talking too fast about it, but we'll go through it many times from here. It's part of the P&L graph post that I put up. So I bought the 2700 put for a very cheap price relative to what it's worth now. And now we're trading 2650, and I'm going to sell 2 of those 2650 puts, taking in premium. So let's say I bought a put for $1. I'm now selling the 2650 put for $10. So that's 2 of those, that's 20. And the other put I laid out 1 for. So I basically have collected $19 for a spread that if it goes out right here will be worth $9 the other way. But of course, I'm risk averse in a sense. So I'm going to buy the 2600 put. So your position ends up looking like this. When you strip away all the words and rhetoric, you're long the 2700 put once, you're short the 2650 put twice, and you're long the 2600 put once. That's called a put butterfly. And you make money, you maximize your profits if the market sits at 2650. That's on top of the money that you've already made or booked with the premium. The butterfly goes out worth 50 points or $50 or 50 handles if the market settles at 2650. Anywhere above that or below that, it's worth less. So if SPOOs rally to 2750, you don't lose any money, you just don't make any money. You only lose the money that you've invested. But in this situation, you've actually collected money. If the market goes down to 2000, that butterfly actually is worthless. You don't make or lose money on it except for the money you've already collected. Does that help out a little bit? That post I put up on options, it's called, people call it a witch's hat. It looks like a witch's hat, the P&L graph. Your long one put, short 2 puts, and long 1 put. That would be the most complex, but actually one of the most risk averse ways to do that. Okay, I'm going to give you a structure that producers frequently do. Producers in oil, as well as stock market participants. Stock market participants are primarily long stock, so I call them producers, and that's not a correct term. Thanks. So the stock market person who's long stock, and he's mandated to. People give him money to buy stock, but he has to buy insurance. I'm not saying he does, but he's supposed to buy insurance. So they'll buy a put and they'll sell a call. They call that a collar, meaning they're putting a collar on their risk. Some people would call it a risk reversal. And in commodities, it's commonly called a fence, although I don't know why. I think it should be called a strangle, but we're not going to get into terminology. It all seems to be um, R-rated terminology: straddles, strangles, and three ways. In energy, one of the most common hedges that a producer who grows oil, right, he pulls it out of the ground, will do is the natural order flow in oil is also like stocks. They'll buy puts and they'll sell calls to finance it. One of the structures that they like to do is they'll buy a put. They'll buy a put that they're worried about if the market goes below, they don't make any money. So let's say the cost of producing oil out of the ground for them is $30, and oil's trading at $50. They'll buy the 30 put because below 30 they can't make their payroll, they can't make their debt payments. They stay shut down. So they'll buy that 30 put to ensure well, three-ways are R-rated anyway. Strangles are, I don't know, I'm no Hogan's Hero fan, but uh, uh, they'll buy a put, and that put at the 30 strike will allow their business to run if oil were to go to zero, because they would be making profits on the put. And then they say, well, we're contracted to sell oil at $100 or 70 or $50. We don't care. We would love to sell it at $100. So they'll sell like the 80 call or the 100 call. So now they bought the 30 put and they sold the 100 call. But they also know, well, they feel they know that the oil market won't go below $15. And they know that because of relationships, because of inside information, because of business models like uh, Saudi Aramco would shut down if oil was under $15. They won't let it happen. There'll be production cuts. OPEC would never let that happen. So what'll happen is they'll create what's called a three-way. They'll buy that 30 put to make sure that they're in business if it goes below $30. And then they'll sell the $80 call, let's say, because they don't care if it goes to 80, they'd be happy to sell it. They also sell the $15 put because they know if it goes under $15, there's going to be some intervention for the industry, whether it be OPEC or national. But that's basically the idea. That's called a three-way, or a put spread versus a call. Those are very common structures in oil. Precious metals, there aren't a lot of option structures that are common because precious metals miners are idiots and they don't hedge their production properly. And that's why they don't make money even when gold goes up. Any other questions about that? Looks like Tom's going to be a little bit later, and I'm going to be. I got to hop pretty soon, but I would like to answer any questions if you want to talk about volatility or something that I can talk about looking at the screen. Okay, it's 2:31. I'm going to call it. We have, I think, something coming up at 3 or later. Oh, I'm waiting for you, Gabe. Sorry, there's a little bit of a time delay here. How about if you can't think of something, you want to go back to covered call rights or something like that? We could do that, or we could do something a little more esoteric. There's just so much to talk about. I want to make sure that everyone could get something out of it. Okay, look at your screen up there. We have a 1 minute chart. We have a one. Oh, hold on, Gabe's typing. All right, we have a 1 minute chart and a 1 hour chart. Covered call. Okay, we'll do a little covered call. Quick conversation. All right. There's we discussed covered calls. I think actually pretty thoroughly last class. But I want to talk about the effect of covered call trading and what it actually does. It has diminishing returns because if you remember the smiles that were put up there, or the volatility smiles of the strikes, because so many people sell calls and so many people buy puts, as in any supply demand situation, the price of the calls drops. So once upon a time, actually, we can talk about gold on this, and I'll tell you why, because this is exactly what happens in gold. Once upon a time, equidistant. So let's say we're trading 2650. Let's say in the S&P. Oh, okay, I see, you missed it. Okay, so then we'll go through the basics then. Okay, so if you're long a stock, let's say it's Facebook, right? And Facebook is trading. Maybe you don't want to be long Facebook. Let's pick a different stock. We can pick. We'll just stay with the S&P because it's up there. All right, so you're long the S&P, and you just bought the S&P. Right, it's trading 2663. You just bought it at 2663. Right, you just bought it there. and you're bullish because you're putting your money in your 401k, and this is an investment. This is not a trade. Citibank, okay. We can do that next if we have time. 2650, 2663 is where you just bought the S&P, and uh, you're bullish on the market, but you'd like you don't really feel that the market you'd be ecstatic if the market went above 2800. Okay, and you would like to be able to uh, reduce your cost. Oh, you want to do Citibank too? Okay, you guys, I have to change my screen. Let me see. Uh, Citibank, the ruiner of the gold market. Citibank and Goldman. Robert Rubin. Citibank was basically Obama's advisory firm, and Goldman is Trump's. All right, U.S. stocks. All right, let me get my banks up. All right, so C is Citibank, right? I'm not crazy. So Citibank is trading. I'm live, but I'm lagging here. Citibank, I have at 58.80, down $3.50. Okay, so you bought Citibank. You're a really smart guy. You bought Citibank at $50, and it's trading 50. Actually, no, you bought Citibank right here. We'll call it $59, and you think that you bought it because you're going to own it for 5 or 10 years, and you say to yourself, well, and this is one way really you should do it. You say, I'd be happy with a 10% rate of return per year for 5 years. So that's a 50% change in price over 5 years. We're not doing any compounding today. So 50% of $59, let's round it up to 60. 50% of $60 is $30. So you would then add $30 to the price. So that's 60 plus 30 is 90. And you would, in this situation, sell the $90 call. And you would sell it one of two ways. You'd either sell it 5 years out, which I wouldn't advise. I wouldn't advise doing any of this until you actually had a complete understanding of all the risks that you're taking. But you would sell the expiring month $90 call. Say every 45 days, every 30 days, you would do that. And what that would do is it would take in some premium. So you would sell a call and say take in $1. And that dollar can be looked at one of two ways. Can be looked at as if the market doesn't go anywhere, you're going to make that dollar and keep that dollar. That's a dividend on the stock for you. Another way some people look at it is it lowers their cost basis. So I did buy it at 60, now I'm buying it at 59. And then another month goes by and you sell another $90 call that goes at worthless and you make another dollar. And before you know it, you're making money, you're creating dividends for yourself. The reason you're not worried about this is because if the stock rallies, you're going to be happy to sell it at $90 anyway. So when the market does rally, let's say you have your dream come true and the stock goes from 60 to 90, Citibank actually uh, 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 becomes an ethical firm, I guess. Anyway, Citibank Citibank is bought by Goldman Sachs, or vice versa, and it goes to $90. You now have you say, oh, I want to sell it at $90 because that was my target, but you don't have to because you're long the 90 call. Now you have other options that Tom McEntee would be happy to talk about, as would I. But I want to keep this straight laced and straightforward right now. So at $90, that call, let's say the stock goes to $92. Well, let's say it goes to $100. You can't sell it at $100. You've already pre-sold it, or you have an obligation to sell it at 90 to someone else. So let's say you do nothing. If you do nothing and the stock goes to $120, you would have the stock called away from you at 90. So you gave up $30 of upside, but you did what you wanted to do. Now, if you had been doing this for 6 months, you had taken in $1 a month for 6 months. So that's $6, and you lowered your cost basis from, say, $60 to $54. So it's a reasonable thing to do, and a lot of people do it if they want to create a dividend, because, and this is why people short options. In 2/3 of scenarios, you make money on options. One, If the market doesn't go, let's say you sell a call, the market doesn't go up, you make money. If the market so if the market goes down, you make money, I should say. That's scenario one. Scenario two, the market goes sideways, you make money. Scenario three is the market goes up, you don't make money. Let's say it goes in the money, the option that you're short. So one of the reasons that people will do what's called covered call right, or covered rights, or covered call selling, or I'm probably confusing my terminology here, but it's called a buy right or covered call trade, where you
I
long
mean, you sell wrong. If you buy right, you sell wrong. The other side sells wrong.
right, exactly. Tom, you're on.
Yes, I was trying to get your. I can't. I don't know why I can't get my screen to load here. But
That's
I
okay. That's okay. We're talking about Citibank, and we did a hypothetical, and actually you can take it from here, because the hypothetical, because I did the Gabe missed the last one, which actually was a really good seminar on covered call writing. But the example that we were using was Citibank trading. I'm going to call it trading $60, even though it's trading below that. And a person says, I'm long Citibank, I'm an investor, and I think it's going to go to $90 in 5 years. And that's $30. That's a 50% rate of return in 5 years. That's 10% a year, no compounding. So, that's what I think. And if it ever goes to $90, I would sell it. And so he picks a $90 call to sell. And if you can't pull up your options up, maybe you can just shout values out to him.
Yeah. Okay. Well, I mean,
and then the
furthest.
choices.
Yeah, the furthest I can go out is January of 21, so roughly 2 years from now.
No, but we want to do a short dated option that he rolls.
Yeah.
I think we want to do.
Oh, I see. Okay. Okay. All right.
So the 30 or 45-day option. That's the one that I think makes the most sense right now.
Yeah, and which is kind of what we talked about, I guess, with what we talked about Google, I guess, on
yes.
Yeah, I would sticking with that. I mean, without looking at let me see the chart of this thing here. I mean, this recent thing, 67. I would look to sell like the 65s out in Jan, regular way Jan expiration, 65 calls, roughly gets 70 cents. What's that, about 1.1?
Yeah, but he doesn't want to. In this scenario, I'm speaking for him, even though I'm really not.
I got you.
He doesn't think the stock's going to go to. He would be happy to sell the stock at $90. So just to make a point, what is the 90 call worth? Which is probably pennies.
It's nothing. You're not getting nothing. I mean, there's nothing.
Correct. So the point of that is, if you're doing the short-term option and you sell the short-term option, Gabe and XDM, because you want to have the choice if you want to do it again next month. So using the math, right? I'm going to do the math like this is my own portfolio. I think Citibank's going up 10% a year for 5 years. So I think what's 10% of 60? So it's $6. So now what that does to me is I say, well, all right, it's $10. Wait, 6, 10, 6, it's $6. So I think that the market's going to rally 10% a year over 5 years. So I think it'll be at 90 in 5 years from now, which means, extrapolating my math linearly, I think it'll be at 66 at the end of this year. So if and this is, I'm making a simple thing complex so I can reduce it. So if it's going to be up $6 in a year, how much is it going to be up in a month? So it's going to be 50 cents. So theoretically, you could sell, a 60.5 call. But what Tom's doing is he's saying, well, we're going to sell the 65 call because it's in the sweet spot, I believe, of premium, as well as it's only 30 to 45 days to look at. So
yeah, absolutely.
I wanted to just steer that so you could come back and do the 65 call, because the 90 call is worthless at a short dated option.
Yeah, I mean, essentially, if you sold the 65 here, like 60 cents, sorry, 70 cents, you get like 1.2%. We'll say 1% of what the underlying's worth. And I think you should just continually roll that. I mean, I didn't pick the 65s out by accident. I'm looking at roughly, 10% away from here, 10% higher than where we are.
Yeah,
right now.
which is actually perfect. That's the point. So you're going to make if the stock doesn't go up and it goes sideways, and that option goes out worthless, you're making 1% in a month. So if you do that 12 months in a row, you're making 12%. Or you conversely, you could say you're lowering your cost basis by 12%, give or take. Does that make
Right.
sense?
That's exactly what you're doing. That's exactly what you're doing. You're selling. I mean, I think we spoke with Google. I mean, especially right now, I think the sum of the parts are greater than the whole because of what's going on in the volatility regime. So yes, I would advocate selling, like I think you advocated, selling, shorter dated stuff, 45-day stuff. Yeah, that's perfect. That's a good
Yeah.
trade. And Vince is right. This is, I mean, what you want to do right now is if you're in front of your screen, take a snapshot of where these prices are right now and make a note. 43 days, 1% calls I'm sorry, 10% out of the money calls in City, we're trading at roughly 70 cents or one and change percent, 1.2%. And then let's look out, perhaps the volatility calms down in the next 2 or 3 weeks. And we're not at these heightened levels. And let's look at where we're 10% out of the money call with roughly a congruent number of days left in expiration trading in Citibank. Then, I mean, these are where you want to sell volatility. And obviously, sometimes it's easy to say it, but this is where you want to sell. This is where you want to buy right. Okay, I mean, not in a 10 VIX environment. I'll say that. Obviously, for the better part of 2017, I look like an idiot, because that's all it did. But this is where you want to sell. This is where you're going to get paid. Now, does that mean the stock's rallying? I have no freaking idea. But this is where you're getting paid to sell options. That's a fact, period. When it's 10 VIX or 12 VIX and everybody's a hero, everybody wants to sell. I would love to own Citibank at $50, and I'll sell those puts that are currently 51 bid right now. I'll sell them at 32 cents because that's stealing. It's like buying the stock at 49.68. First of all, it's not like buying the stock at 49.68 because your gains are capped at the amount of premium you took in. So you got to get rid of all these specious arguments advocating premium selling at becalmed spots in the markets where people are very, very good sellers when it's easy to sell. It's hard to sell right now, no question about it. But that's why you're getting paid, and you're going to get paid here because now you're getting some rich premium levels across the freaking board.
Right. Options are valued. I think this is worth looking up. The behavior of people that trade options, and I'm not talking about professionals that are market maker types, although we're subject to it as well. You want to go back to an economics book, and you want to understand that options behave like Giffen goods. The more they're worth, the more people want to buy them, and the less they're worth, the more people want to sell them. Kind of like perfume or diamonds. And once you understand that people trade options like Giffen goods for the wrong reason, they buy it because it's up, they sell it because it's down, like some sort of a status symbol, then you realize that's the first step in trading like a person like Tom does. He doesn't sell it when it's cheap, he sells it when it's expensive. And options give that opportunity because people are so freaked out when vol does go bid. Look up Giffen good and do yourself a favor, because options behave like Giffen goods. And that's why there's a lot of opportunity in selling them when vol's bid or in buying them when vol's cheap. Sorry to interrupt.
No, that's fine. But Vin makes an excellent point. Vince makes an excellent point. That's exactly what it is. Trading options is very, very counterintuitive. It's that when everybody wants to buy puts, you should be looking to sell them because now you're getting paid. And I'll tell you, the biggest money has historically been made in these things. Being able to sell a pumped up put, at or near some type of an inflection point. Like, obviously, who the hell knows what that inflection point is, what that nadir is? But that's where big money is made, where you can make some decent money because you're making a stone cold statistical bet at inflated prices. That in the long run, you'll make money, and that's all you care about. If I make this bet enough times, how will I do? Well, you'll do well, because I want to give you 20 to 1 on you rolling double sixes when the odds are 35 to 1, right? So 1 out of 36 shot. I'll give you 20 to 1 all day on that. Keep rolling them. That's what I want to do. I think these things are overvalued. I want to give you 20 to 1 on a 35 to 1 proposition. Go ahead. If you win, you win. That's fine. I'm a big boy. I'll pay out. But I know the odds are in my favor, dramatically in my favor, especially in the stuff that expires tomorrow. And there was some stuff this morning that was just off. Very, very pumped because there's fear. There's fear because everyone's cavalier. Vince has seen it, and Larry's seen it. Anybody who's traded options at all for any length of time has seen it. Everyone's cavalier selling it in low VIX, in a low vol environment. It happened before. It happened 2 weeks ago. It'll happen again in 3 or 4 weeks. It's just a fait accompli. That's just the way it goes. But you got to be able to recognize it, and got to be. And if you're willing to buy it there, if you are willing to buy it there, realize you're probably not getting the bottom. You get bottoms the same way you get tops, by accident. But you just want to buy a little bit and then buy a little bit more, realizing that, hey, I'm buying a depressed asset at a good price. You'll give me 35 to 1 and what's a 20 to 1 proposition. I'll do that all day. All I got to do is hit once. That's the way I look at options. All I got to do is hit once on this stuff, because now you're getting a chance to really trade. And if you're watching the entire board, if you're watching the entire and the interrelationship between these things, if you want to line up congruent deltas and things, there's a lot of things to do here without making a directional bet. I mean, this gets into a little bit. This is a couple classes down the line. I wanted to avoid it, but hey, it's out there, so something to think about when we do get into it. I mean, now you can really arbitrage volatility. You can clip that skew out of calendar skew that's in there and vertical skew. Notice these puts are jacked. Any of these black swan, fat tail, black swan puts are jacked, and for good reason.
I don't think they can see your screen. Just so you
know. I know. I'm sorry about that. Look, guys, I apologize.
No, that's because Mike set it up, and
I was.
I know that you're looking at this stuff and you're drooling, but they can't drool. They can't drool with you on this.
Yeah, I mean, there's stuff here, like I mean, I think Mark Fisher said it in one of his things many months ago. He talked about the big advantage you have as a trader is you don't have to make it. You don't have to trade every day. That's so true. You can wait for a nice fat. You can wait for a fastball coming over the plate and swing. Now you're seeing fastball. Now you got some fear. You got some chum in the water, and now you want to make as many bets as possible. Because I think. Because I know you've got statistical edge in your favor. Vol is a mean reverting game. That's a fact. That's a fact. So I think you want to play for that mean reversion. I think you're getting paid to sell things. A lot of buy writers aren't too busy today. I guarantee you that much. The only people buy writing stocks today are probably professional options traders, because they know what they're getting. Now they're getting paid to do it. They were the other side of the trade. They're probably taking stuff off closing. Now you're getting paid. You're getting paid in a stock. American Express was $114, I think, on Monday or Tuesday. Monday. Currently available below 105 today. That vol is typically about a 16 vol instrument. Trading 20, you could have sold 25, 26 volatility out 2 weeks in that thing. That's real freaking money, period. Doesn't mean you're going to win, but hey, if I do that enough times, I think in the long run, there I go again with those 4 words. In the long run, I'll do very well. And that's all you want to look for. You want to look for these types of opportunities that you're getting. Yeah, the 52-week median express is 19. There was stuff this morning was trading 27, 28. That's freaking big. That's 40% over where it typically trades. And you don't have to take a lot of risk. And you kind of know what your parameters are, where your break evens are, and it's there. It's there, and you want to avail yourself of it, because you're going to see it'll happen. They'll treat these stocks. Look, here's Apple. Or as I look at my screen, there's Apple. It's 100. Vol there has been high, and it's been high for a while. But if you like the stock, hey, look, I know there were a lot of people who like this stock $50 higher. I know they're out there, because that's all I heard about on television was how wonderful it was, and how it was going to go $40 higher off of earnings. That's what I heard. I don't know, whatever. Maybe I was hallucinating. But now at 170, are any friends? Nobody's willing to sell any options. Why not? Because they were too busy selling them at 200 when the stock was 220, and they were selling 19 volatility. I don't want to. I'm a great seller with 19 volatility, but not so much at like 27, 28. That is the perverse nature of the game. Period. That's what it is. Everyone's a good seller at cheaper prices. I know it says a lot about humanity, but still. And Vince is aware of it because he traded it. Larry, myself, the game, no matter how many you want to bring in algos and bots and whatever the heck is going on, the game is still dominated by emotion. It's still fear and greed. And today ain't greed. I don't know if it's the apex of fear, if that makes any sense. I don't know if it's the apex of fear, but it sure as hell ain't greed.
Exactly. I told her, I did mention earlier, everyone, that we had a divergence. The VIX made a new high, but the RSI did not. And this was about, I don't know, an hour ago. a little less than an hour ago, and I said that stocks are probably a buy right now.
I
And
think you probably, if you look this, I think I put it in the chat before I had to go out.
we'll see where that leads us for the rest of the day.
I think that's a good point. I mean,
Thank
those
you.
are the things you got to look for. You look. Vince is right. I mean, look for stuff like that when you see VIX. When you don't see confirmation, you don't see that type of confirmation. Look, what's going green? Facebook turned its head up. Take a look around, see which way the wind blows. It's apologies to Jim Morrison. Tesla. Well, we all, Vince and I both know it's a beacon in the financial storm.
No,
Tesla's
a whole
quality.
I'm gonna get into that right now. Hold on, XDM has a question.
Go ahead, XDM. Where are you?
He wants to be long Apple 200 calls and not go broke. How should I play it?
Okay, you want to be long.
My suggestion is borrow money from someone else. I think he's well, I guess the concept is, I know he knows what he's talking about in this stuff, and he wants to be long the Apple 200 calls and not go broke. So obviously it's low, medium, high risk, maybe a call spread or a fence.
Yeah, I would XDM. I do two things, and this is off the freaking cuff. I'm just looking at, obviously I could firm this up for you. That's not a problem. I think you're aware. You think the 220 line is in play. I mean, you've been looking at something like that. Look, I mean, I look at the PAR 215, the April PAR 215, 1x2, buy one, sell two, buy one, April PAR, sell two, April 215. Cost you about 55 cents. Okay, it's a flat delta thing. Now, that's accomplishing two things. You're selling inflated volatility. You're selling 4-month dated options at 27 vol, when historically it's been about 19 to 20. So you're getting paid there. And I think you're leveraging the old high of 232. I mean, your break evens are framed at 229 spot a half, we'll call it for argument's sake, and 200 spot a half. But I mean, if we were to meander about, look, I mean, I kind of think, and I put it in the chat this morning, so I'm not BSing you. Like, I kind of thought the stock was wallowing around that old low, that the market kept going a little bit lower and the stock wouldn't break. And I saw stocks like Procter, which is usually a safe haven in times like this, kind of languishing and setting weekly lows, if you will. Maybe that's rotation. Maybe that was rotation. Maybe a smart guy was rotating and buying and getting long Apple at 172 and selling or shorting Procter at $91. But I think here in Apple, this thing is going to give you. If I went out. Let's look out to the end of the year. Say we did this thing, we paid 50 cents for it. Out to the end of the year. You're profitable up to about 190. So about 10% higher than here. You're going to turn down there. I could, you can go out a little bit further. You could do the 205, 220. That's an interesting spread. That would cost you about 60 cents, about the same thing. Or you could do this. You could take advantage of the inflated stuff here. I would buy one of the April PARs at the $3.60, and I go to Feb. Why don't you sell the Feb PARs at $1.85? It costs you $1.80 for that. That's not a bad look. I don't. And now the first you get two things. Now you're long Vega, which I'm not wild about. Once again, Vince, why don't we tell them what Vega is?
I think XDM knows. Vega
Okay.
is volatility, but for everyone else, Vega's volatility and 1% volatility is a change in how wide the standard deviation is around the market. So volatility is how you measure something that moves away from the average. So you have a guy, and he's standing with one foot in a bucket of hot coals, and the other foot is in a bucket of dry ice. So on average, he's okay. But his volatility is very high.
That's very good. Well put. I've had a number of days trading like that, if I remember correctly. Hey, XDM, you know what I'd look at? I just looked at this. XDM, we're here for you, buddy. First thing, you know what I like? I like 810 Feb PAR. 810 Feb PAR call spread. Pay 20 cents. Like it. We got to move back to like that I think that 192.5 level in the stock, kind of where the gap was, where the gap got filled back about 2 weeks ago. I think that's a decent spot. We get up in there. I mean, you're going to profit too. You're taking on 8 Vega, but it's not going to matter if you get this kind of move. Your absolute outlay is about 20. It's available about 20 cents right now. That's a good spread. April, I'm assuming you can hear it, but I will put it in the chat. But the chat anyway. April 210, Feb 200. CS means call spread 0.20 debit.
There you go.
I have an accounting background, XDM. That's where the DR came from. Debits to the window. I graduated with an accounting degree. I lasted about a year and a half doing accounting. I couldn't take it. It's just very, very boring for me. But that's a good spread, man. That's a good spread.
I'm gonna step off because our time is almost up, and I think there's something at 3:00. It's 2:59 right now. Tom, thank you for joining us, XDM, and Gabe and whoever else was too shy to speak. We know you're out there. We can see your names.
Hey guys, thank you so much. Hey Vince, I'm very sorry I'm late. It won't happen again. I had some stuff that was kind of it was unavoidable. But
it's life,
hey, I appreciate it. I applaud the fact that we're a team, and you went and endeavored. You got to look, as I'm sure all of you know, or maybe you don't know, maybe I don't know, but it's tough talking for 30 minutes by yourself. I do it to myself after about 9 or 10 beers, but
exactly.
Usually, it is.
Anyway, guys, all the time.
Anyway, guys, I want to say thanks to Vince and Mike for working with me. I appreciate it. I hope we brought you some knowledge, and hey, you can bring us some knowledge too. Just keep the questions coming.
Now, there's a guy lingering in the background. J Links, speak up, my man. We're here. All right, we do a lot of this. Everyone, I think, is busy right now trading and ripping their hair out, whether they should be selling more or buying. But we know you're all out there. Thank you for showing your face. Catch you later on.
Great, guys.